earning income as an investor in 2020. I know we've had one disclaimer. Here's another one. And this is quickly what we're going to run through, the global backdrop for income investing generally right now, and then start to home in on equities, which is much more my background as a former equity analyst at UBS Investment Bank for 12 years. Although covering tech stocks, I didn't see that many dividends, if the truth be told. We'll then look specifically at UK equity income, which I'm sure is a subject dear to the hearts of many of you. A little bit of pointers towards checks that you can make if you're looking to run your own portfolio, and they'll certainly be the checks that your portfolio managers and chosen fund managers will be running for you. And then just a look ahead to the future, and then a few conclusions to pack in to the 20 minutes or so. So this is where we are now. Global interest rates going back the thick end of 20 odd years. And basically the trend for all the lumps and bumps is from the top left-hand corner down to the bottom right-hand corner. And it's really the development since the great financial crisis of a decade ago that have placed such an enormous premium on income. It seems like a lifetime ago now, but 13, 14, 15 years ago, you could still pick up 5 to 5.5% for running a UK 10-year government gilt, which now looks like picking money up in the street, but such is the benefit of hindsight. So we're now in an area of record low interest rates, and certainly that's partly down to the failed attempt effectively to raise interest rates over the past year or so. Whether that was down to a weakening economy, I think it's possible, but certainly the COVID-19 outbreak and the economic impact of that has had a big say in it. This just looks at global interest rate increases around the world over the last 5 years. The bars are rate increases, and the cuts are rate, and the red line are rate cuts. And as you can see, 2018, as the Fed began to tighten monetary policy, there was an expectation that other central banks would follow, and one or two did. Even the Bank of England squeezed out a rate rise or two. But that caused a bit of a flap in the financial markets in late 18, early 19. The Fed began to backtrack. The US economy, perhaps not quite as strong as everybody thought. And then, bosh, comes the COVID-19 outbreak completely out of left field, with the result that this year so far, I think the tally is now 133 central bank interest rate cuts and just 4 increases. And that's why we're looking at record low interest rates again right now. What's that done? Well, it means that government yields have ground lower. These are the 10-year benchmarks for the UK, Germany, the US, and Japan. And again, simple trend, top left to bottom right, and that has left certainly two sources of income: cash because of interest rates, and bonds, in terms of sovereign bonds at least, looking pretty skinny in terms of at least the income that they offer. Now, you may still think that the yields on offer here and some of the capital protection you get is a pretty good deal. You'll certainly perhaps think that if you're feeling deflation is coming around the corner, or indeed that central banks will continue to crank up QE and buy these instruments in a price insensitive manner, because you could still squeeze some capital gains out of them. But income wise, it's pretty tough sledding right now. And that does mean that, again, you go to the right hand side here, you've got UK gilts and cash offering some pretty nugatory yields. And therefore, as investors, you are effectively being forced up the risk curve. Now, this has been a central bank policy for some time. Their goal, at least to some degree, in addition to making borrowing cheaper for governments, for companies, and indeed for yourselves, consumers, they're looking to create a wealth effect by creating, trying to stimulate interest in other asset classes beyond cash and bonds, get the asset prices up, create a wealth effect. Now, whether you feel that's ephemeral wealth will be up to you, something that you may not necessarily wish to rely upon. And I think that's a distinct risk, but it's a policy that central banks have espoused for some time. And it does mean, if you are looking for income, you are being forced up the risk curve, whether out of cash into bonds or bonds into equities, onto certain other types of fixed income instruments that we'll be hearing about later on. If the more yield you want, the more, to a degree, the risk that you're having to take, whether it's through equities or real estate investment trusts or convertibles or emerging market debt or high yield debt. And there are people who are much more expert on these topics to talk about them later on. But that's the trade-off that you're having to make: risk, reward. And it's just a matter of how far you want to go in terms of relative to your time horizon, your investment goals, and your appetite for risk. And remember, appetite for risk is best defined in an investment context as your ability and willingness to suffer losses in pursuit of gains, or indeed in this case, pursuit of income. So global equity income is definitely an area where people have been looking for some time over the last 10 years. And you can see a wide range here. This is just up to the end of 2020, and I've cut it off there for a reason. which I'll explain in a second. But you can see some interesting trends beyond the UK, increasing dividend yield in Japan, for example, under the auspices of Abenomics, as Japanese companies have started to fall in line with the concepts of efficient balance sheets and shareholder rights. Asia, perhaps sometimes an underappreciated pool of equity income. Western Europe as well. The US, not so much, although they have generally supplemented dividend yields with buybacks. And then the UK and Eastern Europe, looking with some very, very plump dividend-looking yields there. The UK, really just as the COVID crisis began to crank up, on paper at least, offering a dividend yield of something towards the thick end of 6%. But unfortunately, like so many football teams that I support, good on paper, not so good on grass. And unfortunately, the UK doesn't look like in the end is going to deliver that very, very fat, tempting yield that looked so promising just say 2 or 3 months ago. And this really, unfortunately, comes back to a cycle that we've seen before. J.H. Clapham's magisterial Cambridge Economic History of Britain talked about the dangers of blind capital seeking its 5%. And that's not him being rude about investors necessarily, though I admit it does rather sound like it. But it much more comes back to many examples, one of the prime ones that he cites being the railway boom of the 1840s. Interest rates were also at zero, there was greater wealth around, and Victorians were looking for a return on their cash. Along came the railway boom with people looking to build out railways, and they were offering stock with coupons or yields of 5% or more. And not too surprisingly, piled in. Unfortunately, that worked for a while, but only for a while, and the boom burst. The building stopped, and in some cases, Ponzi schemes emerged. George Hudson from my hometown of York turned out to be running little more than a Ponzi scheme, with the dividends and coupons being paid by fresh cash coming in from fresh investors. And ultimately, there was a genuine rail crash. Coupons were cut, and the railway stocks didn't prove to be such a good investment after all. So that 5% tempting figure relative to zero in the bank just didn't prove to be there, unfortunately. And also, just to compound it, loss of income was compounded by capital loss as well. So what's the equivalent this time? Well, you're all familiar with the numbers. We've seen some pretty brutal dividend cuts in the UK equity market this year. These figures are only, I think, a week old, and they've changed. You generally get the picture. We have had a little bit of good news with M&G and United Utilities and Severn Trent confirming dividend payments in the last 2 or 3 days. But the cuts overall have way outstripped the keeps. So you've either had cuts, suspensions, deferrals, or cancellations of dividends in some case, worth a thick end of £30 billion from the UK equity market so far this year, with retentions now I think at around 13 billion. But the cuts or the deferrals or suspensions have way outstripped those firms who've been able to stick it out. And so I think now when we come to it in a second, you're looking at a UK equity dividend yield now for this year, probably closer to 3 to 3.5%, rather than that fat, juicy 5 to 6% that was being dangled in front of us just a couple of months ago. Now, why has it gone wrong? I think there are 3 simple problems here. Too much debt, too many buybacks, too little earnings cover. An ordinary recession may well have tipped things over anyway, but the brutal one that we've seen, which has been stunning for its depth, hopefully maybe intriguing for its brevity, but certainly has been stunning for its depth, has caught a lot of companies out cold, as efficient balance sheets have proved to be efficient, but by no means robust, and companies have had to quickly retain cash as best they can to see themselves through the unexpected storm. So this chart here shows FTSE dividend payment over the last 12, 13 years since the great financial crisis. And as you can see, there was probably just north now of what turns out to be a peak of just north of £80 billion in 2018. Looks as if with the final numbers dribbling in June, we're going to come in at around 72 to 73 billion in 2019. And then 2020 is still a little bit anyone's guess, if the truth be told. This is based on consensus analysts' forecasts, aggregated from the bottom up. And you're looking at a figure of around 60 to 63 billion pounds at the moment. It could be that thing assumes that the banks, for example, pay a dividend with their fourth quarter numbers in 2021, and assumes that a lot of companies that passed on, say, the second half of last year, the first half of this year, come up with a pretty big compensatory payment for the second half of 2020. Now, that may be the case, but I think the truth is that none of us really know. And I suspect that prudence, if you take a more prudent approach, one sensitivity analysis I have done is that if you assume anybody who's cut or cancelled pays 0 unless they stress otherwise, like say Imperial Brands in 2020, that Shell 6 to 16 cents a share, and that the analyst forecasts are right for the other 50 odd companies, you probably come in closer to 50 billion pounds a year, which again is that 3% yield. Where we are at 60 odd billion might take you up into the high threes. And again, a big recovery in 2021. Who knows? We shall see. But I think the problems, this is net debt since the great financial crisis across the FTSE 100, excluding the big 5 banks. Companies have returned lots and lots of cash. They've run efficient balance sheets. Cash has dragged down returns on equity, returns on capital. Shareholders have wanted to see it come back to them, and so companies have obliged. But it does mean that in some cases they've run up debt, helped also by merger and acquisitions activities and buybacks. This isn't a perfect buyback model, by the way. It's Bloomberg data, which nets off money raised from shareholders through rights issues and placings against buybacks. Above the line means net capital raisings. Below the line means net buybacks. So that's pretty clear where the trend has been for most of this decade, as companies, again, have worshipped at the altar of the efficient balance sheet, which has left them with weaker balance sheets than perhaps they would like. And I know it certainly sticks in the throat of some people that airline stocks in the US, and even to a degree, dare one say, in the United Kingdom, have been running dividend and buyback programs that were pretty lavish by the industry's historic standards. And now there are bailouts being bailed out, which I don't think is good look publicly. And then earnings cover overall was getting thinner. The UK market's a little bit of an intriguing one, because it was very heavily skewed to a few oil, pharmaceutical, and banking shares. Now, so you've seen some big cuts there, which in itself was perhaps a danger sign, that skew. But overall earnings cover, you'd really like to see it around 2 times, builds a buffer just in case something goes wrong. Well, something has now gone wrong quite spectacularly. Earnings cover proved to be too thin, and again, provide little protection on the downside. So where are we now? Well, these are the current consensus forecasts. And if there is some good news here, it's effectively that these 20 companies, if you believe in them, and I stress that the banks are perhaps an interesting one, the miners are perhaps fairly variable, are due to pay out between them £46 billion in 2020, some 73% of the aggregate analysts' total forecast. So really, focus on, if you're a private investor looking to where's the income going to come from, start doing your homework on these 20 names, and I'm sure fund managers are doing exactly the same thing right now as well. So look down those names yourself. Shell's still up there at a big number even after its whopping great cut this year. Imperial Brands still a big number after a 33% cut. The banks are obviously a big sensitivity here, and so are the miners, BHP, Glencore, for example, and the insurers. Again, like the banks, the regulators lent on them to not pay dividends. So it'll be intriguing to see whether they toe the line for the whole year or not. Prudential, different regulator, has already moved on. Legal & General has ignored the regulator's pleas, saying it's got perfectly satisfactory capital buffers, thank you ever so much. So really, if you're looking at the UK equity market as a base case, maybe it's these 20 pay these figures, the rest pay nothing, or even 1 or 2 of these companies drop down as well. So that maybe gives you some degree of sensitivity in terms of what you're looking at. But that 50 billion figure then that I threw out is pretty much a base case, because it assumes the banks pay nothing. 63 billion, I think, does ultimately rest upon a reasonably punchy second half recovery in economic activity, corporate cash flows. So the UK is by no means close to you as an equity income option, but it certainly perhaps doesn't look quite as tasty as it did 2 to 3 months ago. So what checks can you do when you're looking at those 20 companies, or indeed any others that you're looking at in the UK or beyond the UK's borders? We've already talked about earnings cover, earnings per share divided by dividend per share. You'd like it to be above 2 times, and the same for free cash flow cover. Now, free cash flow is a little bit more complicated. You look at operating profit, you adjust for depreciation and amortization, you adjust for net working capital, and then you strip out the bills that are simply unavoidable: interest, tax, leases, pension contributions, and then you're really in business in terms of knowing what is going out the door on a regular basis, and that's the amount of cash that they've got left for dividend. And that does show up some very interesting things. Companies that optically have got good cover actually get bowled out pretty quickly once you start taking out all of those bills that simply have to be paid. The taxman's not going to lie down, the landlord's not going to lie down, albeit in certain circumstances that they may do, and the leases have still got to be paid. So there are some big cash outflows that you need to adjust for there. And also, although you will probably look at 1 or 2 year forward estimates for those, my suspicion is you're probably better off looking at those figures over a sort of 10-year average or a cyclical average, just because there is a risk, you'll be looking at say 2018 or 19's numbers. You've concluded that cover was good because profits were good, so cash flow was good. So you need to have a look at how bad things can get to see again how much of a buffer is and how low profits can go, and then maybe average out over a decade. And you need to look at these things in the context of the balance sheet, because again, these companies have got those liabilities they need to meet, whether it's interest payments on debt, contributions to the pension fund, payment of leases. In the P&L, keep an eye on interest cover, operating profit plus interest income, divide that sum by interest expense, and again that should be over 2 times to give you plenty of comfort just in case profits come under pressure. And really then you can judge for yourselves properly whether companies in the long run are fundamentally financially sound if you go back 5 or 10 years and they've just been caught out by this extraordinary shock, or whether those dividend cuts were coming anywhere as soon as anything went wrong because everything was pulled so tight. So you really need to get a 3D view here, looking at the P&L, the profit and loss account, the cash flow, and the balance sheet. And if it sounds like hard work, it is, frankly. And I'm the sort of case that actually quite enjoys doing it and going through reporting accounts and going back donkey's years. But I appreciate you've all got other jobs to do. You've got partners and families to look after. So if you haven't got the time, or if you haven't got the expertise, that's how trained fund managers can help. In exchange for their fee, they will do all of this hard work for you and try and help you navigate through to where the income is safest and away from the potential accidents. So the future, they're about UK dividend income peaking at or hitting pounds in 2018. How quickly will it get back there? I think a lot of that will depend upon the length and duration of the lockdowns, the restrictions of the COVID outbreak, and how quickly the world goes back to being what it was, or do we indeed get to a new normal? And also, what are the implications of the economic of the policy response that's looking to tackle the recession? Europe's come out with a plan for a big stimulus package today. Japan did it from Bank of America. There's more than $1 billion now of fiscal stimulus being thrown at the economic downturn, which if you assume that it's say 10% of global GDP that's hit this year, that's a 9 to 10 trillion hit. So there's an awful lot of money being poured into this economic gap. Some people still think we're going to get deflation because there's too much debt in the system and there's been too much of a shock to corporate and consumer confidence. Some people think we're going to get inflation because of the central bank money creation and the supply side shock that you're going to see as people look to onshore and make supply chains more robust. Some people think we'll end up with the worst of all worlds and a return to the 1970s with weak economic growth, but plenty of inflation and price rises in the form of stagflation. Now, the truth is, no one knows. All of those scenarios would require ultimately a fairly different portfolio solution. And that's why we have balanced portfolios in the first place, to try and compensate for the fact we don't know what's coming. As Voltaire says here, uncertainty is not very funny, but being certain about something is probably what's going to get you into an awful lot of danger. So yes, you may be certain that inflation's coming, but there is a chance, let's face it, that we're wrong, because none of us with the best will in the world have got a crystal ball. So just one alternative to think about that would maybe try and compensate for a certain number of scenarios. This is just to flag one area where cash flow is flourishing, because the problem in the last 6 months is that cash flow is shriveled because revenues have collapsed, profits have shriveled, and that has exposed some balance sheets that have been stretched. And it's the gold miners. Intriguingly, this just looks at the Hui Gold Bugs Index from the US. 10 big gold mining stocks listed there. Some of them actually aren't producing, intriguingly, but their cash flow has risen 5-fold over the last 5 years because the gold price has gone up. Surprise, surprise. If you've got an all-in sustaining cost of $900 to $1,000 and the gold price is $1,700, life looks pretty good. If the gold price is $1,000, it looks nowhere near as good. Right now, gold is high, although it is just starting to retreat a little bit. Gold miners are therefore flush with cash, and therefore their dividends are actually rocketing. And this shows the history of gold miners. Those 10 stocks dividends over the last 20 years, and they're still not back to the peak they were paying when gold hit its peak of $1,900 an ounce nearly 10 years ago. Now, clearly the danger is the gold price goes back through the floor. And why would that be? Well, gold is under pressure the last week or so because there's greater optimism about vaccines. There's greater optimism about lockdowns being eased. There's greater optimism that therefore the world economy will start to return to something vaguely approaching normal at some stage within a reasonably visible time period. And if central banks and governments can show that they're on top of the situation, that may well put a lid on gold. Bulls of gold, however, would say, let's face it, ladies and gentlemen, all the fiscal and monetary stimulus they threw at the problem 10 years ago, they never got round to withdrawing that. How on earth are therefore they're going to be inclined or able to get round to withdrawing that 20 trillion plus this time around? They're not. And those people who will argue therefore that there's rampant monetary debasement will look to a potential source of protection. And historically, gold has been one of those. But again, the past is no guarantee for the future. So even here, we have no guarantees. But if you think that that there will be, say, a longer recession than the market thinks, or a longer downturn, or bigger policy response, or that there'll be an inability to withdraw the stimulus that's been put in because there may be another recession coming just naturally at some stage, that may be an area that you would look toward. And again, this just looks at gold relative to the Federal Reserve's balance sheet. And gold has responded to the fact that really the Fed has started throwing vast amounts of money at it since late March, and it's been throwing it at fixed income in particular, an area I'm sure it'll be touched upon later with high yield. So this is a long-standing chart that gold bugs would look at and get very excited about. Gold haters will still come back to the conclusion it's inert, it's useless, it generates no yield, and therefore you have to get involved with gold miners to generate the cash for you. And gold miners, things can and do go wrong, whether it's strikes, whether it's weather, whether it's operational miscues or whatever. So they're not for everybody. They are high risk, but at the moment it is an intriguing area where cash flow is flourishing and dividends are going up worldwide at a time when, frankly, dividends are under pressure in quite a few places. So I'm coming to the end of my 20 minutes. So your need for income will depend upon your overall financial strategy, your target returns, time horizon, and appetite for risk. And again, they are very personal to you. So there will be no one-size-fits-all solution here. And as we've proven in UK equities, it's a risk-reward assessment when it comes to finding income. The UK has not defaulted on its debt since 1672 and the stop of exchequer under King Charles II. So in principle, if you lend the money to the UK government by buying a gilt, you're going to get it back with your coupons paid and get your principal return at the end. What happens with inflation in the meantime? That is something that you still need to consider, particularly if you're prepared to buy a UK 10-year gilt, where the coupon is currently 0.2%. And you still need to think about the long-term implications of COVID-19 and policy response. Will companies hoard more cash, pay out less by way of dividends? Inflation, deflation, stagflation will also affect your macro view and maybe which assets and asset classes you think may work quite well. Equities, I still think, are a valid source of income, including the UK, but there are other geographic options to consider, as we looked at earlier on briefly, and you will need to do careful research if you're looking at individual stocks or asset classes where you can get a fund manager to be the expert for you. And again, when you're looking at individual stocks, you need to ask yourself, is it just a COVID short-term hiccup, or is there in fact a fundamental weakness in the company? Was its competitive position fragile? Was it over-leveraged? Had it made an acquisition that was potentially overpriced, that had weakened it for the long term? And as a final point, just think about politics. If politicians and central banks do decide that they are going to try and fund properly the stimulus they provided, how do they go about it? Taxes is one possibility for politicians. And again, companies that have taken rate holidays, VAT holidays, used furlough schemes, I can't imagine it'll be smiled upon by politicians or the public if those firms then start paying out lavish dividends. So I think, again, we need to have a very careful look at how firms have behaved and whether that will affect in the future, at least in the near term, their ability to return dividends to you.